Good morning and welcome to your Monday, December 16th market news update. Euro traders brace for the block services activity update for clues about the euro's future. Bitcoin hits fresh record highs as crypto optimism remains strong. Domestic consumption in China underperformed for yet another month, pressing the yuan lower. Manufacturing growth in India tops estimates and exceeded historical averages. Dovish outlook from BOC tackles the loonie and sends it near four-year lows against the dollar. Precious metals slide ahead of the Fed's highly anticipated rate decision. Finally, China's NBS officials call for sustenance of recovery efforts to allow the economy to grow. That's all for now, and stay tuned for tomorrow's market update.
Hi everybody and welcome to another daily presentation. This is the market overview for the 16th of December of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. Now, the first and sole topic of the day is going to be about Eurozone, and more specifically about the indicators, the recession indicators that started to blip. Now, over the weekend, we have seen from France receiving a downward revision of its credit rating from Moody's, as the collapse of the National Assembly earlier this year casted doubt on the government's ability to effectively handle its fiscal and budgetary problems. So the concern over finances led the credit agency to cut the credit rate of the nation to negative, down from the AA to down to the AA3, citing that there is a very low probability that the next government will sustainably reduce the size of its fiscal deficits beyond next year. So the credit rater has also added in its statement the following: now, we forecast that France's public finances will be materially weaker, over the next 3 years compared to our October of 2024 baseline scenario, and at the same time, it has altered its sovereign outlook from stable to negative for France. Now, beyond France, the economic news releases earlier today has strained the euro, as we have seen Germany's manufacturing downturn unexpectedly deepening according to these kind of preliminary PMI data we have received for the month of November. And we saw more specifically factory orders dropping with the steepest pace year to date, and manufacturing contraction in November has wiped out any progress made in the prior month. Now, Germany's private sector is also not performing as well or much better, as we have seen growth was pretty much absent for the sixth straight month, underlying this kind of prolonged market weakness in demand. Okay, so neither good news from Germany nor France. What would you expect to see for the whole bloc as a whole? Nothing much, to be honest. So staying on Germany, we have Also, we are also waiting for Germany's Chancellor Olaf Scholz speech earlier today, as he has most likely going to face a no confidence kind of vote since people, all German citizens, have grown tired of no changes amidst a national identity crisis and are in definitely a desperate need for having a government able to run and turn the economy around and exit this kind of years-long contractionary phase. So overall, problems are still mounting for the bloc as a whole. The euro, for some reason, stands still in today's session. Maybe negative sentiment is going to pull through later on in the session. And speaking of negative sentiment, we're going to talk about European stock markets. We have, for the time being, also reacted modestly to this kind of fresh bout of negative data. And at the opening bell, we have seen EU 50 all stocks, 50 European equities sleeping by 0.3%, which are, for the time being, from our point of view, reflecting a cautious stance from traders up until further notice. So, yeah, further weakness is expected to come from Eurozone if we get this political situation both in Germany and France fixed in the immediate future. Maybe we're going to get some sort of a rebound. But for the time being, no such thing is in sight. Okay, so we're going to keep this session short, guys. Thanks for watching, and hopefully we're going to catch you on to tomorrow's session for another brief update. For the time being, take care. Bye-bye. So let's not waste any more time and let's dive right into it. Welcome to another webinar of our series. Today we're going to talk about support and resistance, and more specifically, we're going to talk obviously about the basic tools, which are support and resistance levels, which identify crucial areas that are of importance that traders actually use in order for them to just gauge the market and see whether which level is more appropriate to enter or exit a position depending on the situation. So today we're going to introduce the concept of support and resistance, what constitutes a support and resistance, a valid a support and resistance level. And we're going to talk also about some key terms such as pullbacks, overlaps, and swings. Finally, we're going to go on a live environment and just plot these lovely and easy to use kind of tools, support and resistance levels, to get a grasp of how traders are indeed approaching this kind of situation, or their trading strategy accordingly with the usage of support and resistance levels. Hopefully, we're going to find some key insights that are going to help us trade even more better. Okay, so without further ado, let's just get started. Support and resistance is the first out of two webinars of our series on this kind of topic. Let's begin. So this is a quick risk warning and a disclaimer. I'm not going to go over this. You can read this on your own time. The gist of the content of this slide anyways is that this information is purely for educational purposes only. There is no investment advice or investment recommendations within this kind of session, and the redistribution of this material is strictly prohibited. For the time being, this is it. Let's get started. So, as we mentioned at the start of our series, there are different types of technical analysis, at least different ways of categorizing the key aspects of technical analysis. This is a visual representation of what I mean. This is my personal preference of conveying this kind of information. So we have two pillars or two brackets or two umbrellas or whatever you want to call it, two teams, doesn't matter. So we have charting analysis and mechanical analysis. So charting analysis, in a sense, uses support resistance levels, trend lines, channels, and chart patterns as the primary kind of components of conducting technical analysis. So charting analysis primarily takes place, if not all the time, on top of price action. So you have a chart with price action across time, and then you go on top of that chart and you draw your lines and you highlight these key areas of confluence or key areas of uh, possible importance depending upon the past on where the price action has gone over, and you mark these kind of areas, or you draw those kind of trend lines, or you draw those channels, or try to identify what kind of patterns are there on the chart, telling you and conveying you information with the hope of making much more informed decisions, but also for the basic reason of having a visual illustration and not going through the whole thing over and over again and having a guesswork. So you go into the past and you draw these kind of support and resistance levels in order for the in the scenario where the price action goes to those levels, and you at the end of the day having the ability to judge whether they're important or not, and if they are, you act accordingly. If not, again, you adjust your um, strategy in that manner. I will as well. Okay. So charting analysis, once again, the topic that falls under it, and with this is the one we're going to discuss today, are support and resistance levels, hence this underlining and the marking with an asterisk. And we also have another category, which is mechanical analysis, which uses technical indicators. And these are computerized kind of statistics that give you specific information depending on what kind of indicator you are actually using about, for example, a momentum, the momentum of an instrument, whether it's bullish or bearish, or whether there is or not. Moving averages, for example, will give you the confirmation of where the trend is actually headed at, whether the trend has actually ended, has reversed, whatever that is. Oscillators are in general are technical indications that, let's just say, as they do, oscillate or vibrate or move between two bounds. And the higher the number is, it gives you a specific kind of indication, and lower the number is obviously the same thing. So oscillators are calculating like something like open interest, momentum, and many other kind of key concepts of breadth of how the market is working. And we also have under this category moving averages, oscillators, bands and envelopes, and many, many other technical indicators. Most of them, with the exception of Bollinger Bands and moving averages in this kind of list of instruments, those technical indicators are going below on a below the charts on a separate panel, and you see these kind of waves being formed depending on how the price action has performed over the past X amount of time. And again, they give you information. We're going to cover each and every one of these, or at least most of these, in the upcoming webinar. So moving average, we're going to do a special webinar on that. Oscillator, we're going to choose a few of them and present it to you, such as, for example, moving average convergence and divergence, the basic momentum, RSI, and many others. And we also have bands and envelopes, such as Bollinger Bands, which, again, we're going to have a special webinar on that as well. That and moving average, Bollinger Bands and moving average go on top of price action, much like charting analysis, but they are not drawn by you. They are computerized versions of key information that went into them, and they spit you out a line or a value or a signal, in a sense, for you to look upon and make your decision accordingly. Okay, so charting analysis, you can Imagine that by you drawing on a board where mechanical analysis is something that you select to pre-select and spits it out onto your chart and no need to do anything other than adjust the parameters. Okay. So that's one way of conceptualizing. So support and resistance, the topic of the day. So what is support and what is resistance? How are they helpful? How are they not? Can you use them effectively onto your chart and make informed decisions? I believe so. So support and resistance are, again, super basic concepts. We're talking about lines, and more specifically, it's better not to think of them as line as such, much more like an area rather than a specific line that says, you know what, euro dollar is at 1.1015. Okay. So we're talking about that is being the support or the resistance level. We're talking about an area, not specific to the pip or the point of that specific, for example, FX pair. We're talking about an area in general. So an area where you see price action failing to break below or above, depending on that is, it's going to be a support resistance level. And these are the areas we expect price action to stall. Okay. So if the price action has in the past stalled in these kind of areas, we mark them as important, expecting that in the future they are going to act as such at that point in time. Okay. So support is a level or area on the chart where buying interest, more specifically, is sufficiently strong to overcome selling pressure. So imagine that the bears are in control and they're driving price action lower and they fall to a specific level. Let's just say, I don't know, the $200 mark, and you see the price action. You see the bears being in control, and then you see for some reason around the 200 area, round number, you see the prices bouncing from there onwards and not being able to continue falling downwards. So if that resistance, if that support holds for, if that attempt holds for 1, 2, 3, 4 times, that is marked as a key area where you expect to see some sort of support in the future taking place, because that area, for some reason, it was branded by traders as important enough. Whether that is validated or not, we do not care. We care about how the price action behaves, excluding the fundamental aspect of things. We're looking at the situation from a technical standpoint of view without knowing anything else about what has happened with the financial statements of that company or with the geopolitical kind of uncertainty that surrounds that the pair of the currencies of that specific pair or one side of the pair. Okay, you get the idea. We're talking about areas purely from a price point standpoint of view. Okay, so if you see an area being kind of averted or avoided or not being tolerated by the opposite party. Remember, we're talking about sellers pushing the price action to lower ground, and you see the buyers entering constantly within that area. We mark that as support. So you see 1 bounce, 2 bounce, 3 bounces, it constitutes as a support level. Some may like to see only 2 points in order to draw a support level. Fair enough. Most traders use 3. Okay. And if you have 3 points of touching and not the break of the price action to lower ground, you brand that as support and you mark that as an important area for you to weather wait for it to eventually get broken and go with the direction of the market, which is downwards in that example we just provided. Or when you see 1, 2, 3 bounces, you take that as an opportunity to go for a long position. Okay, so buy something and use that support area as your stop loss, expecting the price action is going to rebound from there, and that reversal has taken place. Okay, that depends upon many different things. It's purely irrational to just draw support and resistance level, at least from my point of view, it's irrational to draw support and resistance level and trade purely on that without looking all the other freely available and easily accessible kind of tools you have in your arsenal in order to make much more informed decisions. It's no need, in my head, is irrational to just use support and resistance levels and trade accordingly. Some people do it and they do it super efficiently, effectively, and they make a lot of money out of it. We're talking about beginners here, if you are not familiar with this kind of concept, or if you have not seen enough of these kind of movements, because it's not only support and resistance level, it's identifying chart patterns as well and other major formations that are actually indirectly telling you, you know what, the reversal is going to take place at this kind of level. If you're not familiar with those concepts, if you don't have that prior knowledge and you just draw support and resistance levels and you trade upon them, super hard to make money. I mean, you may get lucky, but the point here is with this series, with this webinar series, is to let's just say evaluate all the available tools you have in your arsenal in order to get a holistic kind of understanding of how the markets are actually working, or the instrument that of your choice is actually working. Understand that, not only the technical part, but also the fundamental part. Get that knowledge first, and then you go on and capitalize upon that, okay? Rather than just learning one thing, which is support with drawing correctly, quote unquote, because it's subjective. That's why I've done the quote unquote support and resistance levels and going at trading like that, okay? So, you know, it's not my way of doing it, so why not? I'm not suggesting you go ahead and do the same thing I do. That's not the point. Point is, it makes much more sense to have more information, okay, at your disposal, and knowing what's going on a much deeper level than people are, and using that as an advantage for you to go into the market and trade, okay? Because most people do not dedicate enough time to learn these kind of things, which are eye-opening, and they are indeed helpful and make much more accurate decisions depending upon that. And you actually go ahead and just use the simple stuff, and you attempt to make money. Most of the time you lose, okay? So why not go through the knowledge? I know it's hard to sit your bum down and just start learning stuff, but if you want to be successful, you have to do the work, you have to sweat, you have to work, okay? So enough about me blabbering. Let's move on back to the point. So support level is an area, is a level or support on the chart where buying interest is sufficiently strong to overcome selling pressure, okay? So when a decline is halted and prices are turning back up multiple times, a support level is identified and drawn, and this can be done beforehand by using a previous retraction lower, or if you see the price action just bouncing constantly from that level, you mark that as support level. It doesn't mean because you mark that level as important, it's going to be important. The price action will dictate whether it's important or not. The market or traders, the cohesive kind of symbiotic relationship of traders will make this a support or resistance level valid or not, because you know how the whole thing unfolds when it comes to market, okay? We're talking about many or millions or trillions of decisions being instantly taken at any point and moment of time by a large amount of people, which maybe have some common ground, or they have different theses. You see this kind of battle in financial markets all day long. So we're talking about a tug of war. We have the bulls and the bears drag it, excuse me, pulling the rope one to their direction or the other. Okay, so who wins is dictated upon who is the stronger one and how much resolve they have in their assessments. Okay, so resistance is the opposite of support, and it represents a price level or an area where selling pressure overcomes buying pressure, okay? And the price advance is turned back. So a resistance level is identified by a previous peak. So you can see a visual illustration here, completely the opposite. You see price action rising to higher ground. For some reason, traders or the bears in this kind of case are not allowing the bulls to continue their advance, and they push prices to lower ground. The bears are taking once again direction. They take the initiative and reattempt to go ahead at this kind of level. They fail. They move backwards. Another attempt, the third attempt, they fail once again for some reason to break above this level. So you mark that as an important area that may play a role in the near future. And again, you can capitalize upon this play here by, for example, going short once you see one to the third bounce, okay, and having a stop loss right at the resistance level or a little bit above it, okay, or you await for the fourth time or the third time or the 700th times, that doesn't matter, for that level to be breached, and then you go long from there onwards. In a sense, you await for the continuation of the trend to occur, to go with the market and go with the flow, and expecting, in a sense, the reversal not to take place, and you expect the continuation to go ahead and happen. So you go long once you see the resistance line being broken by a definitive amount, and you have a stop loss position right at the previous resistance level, which is going to become support, and you capitalize on the upside. Okay, so I've just hinted at how the support and resistance levels are interchangeable, okay, and reversible depending on the situation, and which is this. So whenever a support or resistance level is broken by a significant amount, this is important, they reverse their roles and become the opposite. Now, what is significant? I don't know. If you have a price advance of 10%, so you have a rise of the prices of that specific instrument by 10%, let's just say it's a stock, and you see the price action failing to break above this kind of level, the $200 mark, and you see prices failing to break above it, but once, two, three times, and the fourth time you see a break above that kind of resistance level, okay, by a significant amount, which may be something like 5%, so half of the prior move, or the third, so 3 or 4%, so a significant move above the prior level, okay, you deem that as a continuation pattern, the extension of the current trajectory of that instrument's kind of move, and you go ahead and act accordingly, but the significant amount is subjective. Okay, it might be 1% for you, it might be 7% for someone else if the prior move, upside move, was 10. Okay, it's dependent, but the point is you have to see a clear break above it, so a clearing of that level, and if and only if you see that level acting again post this kind of break above this level, if you see that level become, because it's going to become resistance, because it's going to turn support after its status of being resistance, if it acts as support as well, extra confirmation for going long. Okay, so that's pretty much how it's a simple way to approach the situation by using only support and resistance levels, which is kind of crude and banal and not sophisticated, and possibly not carrying a high level of probability of success. Okay, at least that's from my point of view. If you can trade the markets using only support and resistance levels and nothing else, no indication, no drawing trend lines and all that kind of stuff, and you make money, fair enough. Hats off to you. So in other words, a resistance level becomes support, and support level becomes resistance, if and only if you see a clear breaking of this area. So what is a pullback? It's a super important kind of concept. For example, a visual illustration might be the chart on the right-hand side on the corner. Okay, so the depiction of the resistance. So a pullback might be this area right here. Can I have the pen? There we go. So this can be deemed as a pullback. So the major direction of the market's upwards, and you see a pulling back. Okay, this is a pullback. Okay, this is going to be considered as a rebound, okay, because you bounce from here onwards. Another pullback, not that important. The first one is important, actually. And another rebound, and then another pullback. This may be, if it's actually this, and you have seen breaking below this level, from here onwards is not only a pullback, a temporary pause of price action, is actually a reversal. The whole thing is a reversal, okay? So pullback is essentially a pause or a moderate drop in an instrument's price from its recent peaks. So this is the recent peak, 1 and 2 and 3, okay? So a pause or a moderate drop, okay? So pullback signify potential corrections in the major trend of an instrument. Okay, so you have a clear direction, and at some point in time you see a pullback. That means a temporary correction, and that's the key concept or key theme or key concept of pullbacks. They are temporary in nature. Okay, so if it does continue to move downwards from here onwards, lower highs, lower lows, That is not a pullback. Maybe the entire move may be a pullback, but some may consider this as more accurate of saying it as a yes, retracement, but also reversal. Okay, so those very correlations are often short in duration, and once they succeed, they finish, the main trend continues. So in order for it to be a pullback, the major trend, what is major trend, must carry on. Okay, that is the technical definition of a pullback. Furthermore, many pullbacks can be spotted moving towards to or by bouncing from key support and resistance levels, which we're gonna look at the live environment in a few moments. Okay, hence it is the trader's best interest to spot these movements as it can provide great entry points. Okay, because you're going to capitalize on the expectation that the trend will resume its projected course. Okay, so many people like to buy this. Okay, or somewhere in here. Okay, the corrective, excuse me, the buy the dip of the pullback, and their action is categorized as a corrective rebound play. Okay, so you are waiting for the price action to once again head for that resistance level, hoping that it's going to break above it and you're going to have a lot more money in the bank. Or if you see it failing to break once, twice, three times, you enter here and you close your position as soon as you see the market once again retracing backwards. Okay. Okay, let's go on to a live environment to see much more clearly. You can call that swing as well an overlap. So overlap is going on top of the price action once again. So you guys see that in a live environment. So let's go on to trading view to look upon this kind of situation. Okay. So what do we have here? A chart of gold. So let's go ahead and use some simple support resistance levels. So zooming out. Okay. In my point of view, this is a valid support level because you have what? Once, you have twice, you have three times, somewhat four in this kind of area. Okay, so it has been tested multiple times in the past. It used to be a resistance level, but once it was broken in this area right here, no longer a resistance level. Now it is a support, a valid support level. Let's draw a lovely trend line from here onwards. Maybe we could have drawn it from a lower kind of level. Never mind. However, you see what we call speed lines here. This is a way to gauge how fast the market is moving, but also have a visual confirmation that the trend is actually continuing onwards. You can use Gann fan charts, these kind of things. Okay, so we have a major kind of support area if indeed price action comes back to this. Okay, we expect this area to act as a support mainly because it has acted as a resistance many times in the past, once, two, three, four times. So we're talking about back from August of 2020, March of 2022, April of 2023, and earlier this year, February of 2024, this level being acting as a resistance level. From there onwards, broke above it. So we have the confirmation of the extension of the primary trend, which is upwards, clearly seen here from the higher highs and the higher lows. Let me see. Okay. And let's move in a little bit much more closer. What else can be acting as a support level? I like this area right here. Okay. Not particularly because it has some sort of significance it had in the past. We have one touch here, second there, third kind of there. So that is an area that I would be paying close attention to as a support level once again. So this may happen once again. Also, maybe we can use this area right here. Okay. So one touch. So you get the concept. It's super, super basic. Second here, third break and reversal, fourth break and reversal, but afterwards, clear break above it. Okay. So this area might be super nice for a support level once again, maybe. So we're talking about different levels of pullbacks here, if you expect them to happen. Now there are many ways of gauging how far it can go. Let's just go with a simple measuring of how far or how low can the price action fall. For example, we're talking about the gold being in an all-time high territory, has broken into all-time high territory during yesterday's session. You can clearly see that there, and you see the extension in today's session. So all these are acting as valid support levels. Some have more significance than the others. For example, this one is the most important one for me, in my eyes, mainly because it has acted 4 times in the past as a solid support level. So let me, no, never mind. Let me highlight it like severely. Maybe this one is the one with the second most importance, and the other ones are just pretty much temporary because they have not been tested that much. Okay. Something else I forgot to mention, you can deal with this as a channel. Okay. So as you can see, parallel kind of channel. Okay. 1, 2, 3, 4, 5, 6 times. You can brand that as a channel. You can play this accordingly. So buy low and sell at the top, buy at the support, sell at the resistance, and accordingly short at the resistance and buy or cover your position at the support level. Okay, but let's not go into that much of a detail just now. What we're doing here is that we're seeing the current trajectory of gold. So you can clearly see that rise of the price action, pullback. This is a pullback. Okay, some sort of correction taking place. Second attempt failed, and the third attempt, oh, okay, kicked us out. Forgot to log in. Probably it's gonna start over once again. Lovely stuff. Okay, so once again, this one is one. Second one is down here. Let's just look at it from on the same analysis once again. Third one, okay, maybe fourth one is going to be somewhere in here. Okay, all these are important levels of support and resistance, of support more specifically. How about resistance? Mainly because we are in uncharted territory when it comes to the trajectory of gold. We have to just extrapolate of what might come after this kind of break into all-time high territory from this kind of area, from its previous high. Usually it's just a random kind of projection. You can use Fibonacci extensions and projections about this one actually. But in this kind of case, we may see that somewhere in here, for some reason, around the round number, the 2,600 area, you're going to have some sort of resistance because it's a round number, nothing else, nothing more, nothing less. And we don't have any major other information about where resistance is going to take place next. So we just assume in other charts it's much more clearer where the resistance is. We're going to do another one, probably going to do WTI. But yeah, for the time being, this is how you treat. So support and resistance levels or how you plot them. And let's just do a quick kind of showcase of how you can play this. Where is the orders long position? Okay, so maybe you expect the price action to fall back once again into this area where you're going to go long. Okay, mainly because you're going to see the price action. Let me explain what I mean by this. So mainly you could expect to see a pullback from the top. You expect to see some sort of support taking place here. You have once, you have twice, you have 3 or 4 times there. The price action, and if and only if the ascending trend line, this one, the blue line, does not get broken, you expect some sort of a rebound taking place here, and the extension of the move to higher ground. If that is the case, then as soon as you see the price action bouncing from this area, the 2,400, and let's just highlight it. 2, 4, just keep it like a round number like this. Okay, this area, you go long there, you have a stop loss at the prior resistance level, which has now turned into support, because you have 1, 2, 3, 4, 5, 6, 7, 8, many times here. You expect this area to kind of hold if this one fails. Okay, and you have a target up there for a take profit. So you're risking 2% in order to get 5%. So risk reward ratio of around 2.5. So that's very, very decent. If and only if we see a pullback and then you just capitalize upon that. So that's one way of playing it. Or once you see the price action reaching that 2,600 level, which is a key area, it's key psychological round number. If you see the price action not breaking past that, okay, you can, in a sense, go short at the top, okay, have your take profit down here, and maybe, let's just say, depending on your risk reward tolerance, your risk tolerance, let's just say you're gonna sacrifice 2% in order to get 4.8. So that's a risk reward ratio of 2.2. Okay, not bad, decent when it comes to gold, yeah. But yeah, those are two examples of how you can play this. Or another one may be price action breaks below this kind of support area. So from here onwards, if you see the break below the ascending trend line, you most of the times you expect some sideways price action to take place. Whether it's going to go up or down, we do not know. Maybe it's going to hold above this kind of other longer term ascending trend line, and then it's going to move to higher ground. Okay, if it breaks below that, you can trade this kind of range. Or if this level doesn't hold either and you see plummeting down here, as soon as you see the break below this kind of area, you can go short. Okay, somewhere in here, have this target as the next support area where you're gonna see price action stalling, and you adjust your take profit accordingly. Okay, it's not gonna allow us to work efficiently today. I should have logged in. Can't remember the passwords out of my head, so unfortunately we're gonna keep doing this. So let's move on to WTI quickly. Let's spot support and resistance levels. We are on a daily chart of WTI, and you can see this kind of zigzag, long-term zigzags, and you can clearly point out that this area right here is important. Okay, let's not use this area as an area, as a line. Let's do, where is that rectangular kind of shape? No. There we go. Okay, so we mark this as a key area. Why, you may ask? My point of view is pretty obvious. You can also use a line instead. So this is definitely one. 1, 2 failures, 3 failures, but a break. 4th, you found support. 5th, you found support. Once again, support. Once again, support. Again, supported there. So this is definitely a crucial level that I'm going to be paying close attention to, because you have many bounces and many breaks in the past that switched from resistance to support. Okay, so you can see this as a average kind of value, so super important. This one as an area is also something that I will be paying close attention to. Okay, now it's acting as support. If it breaks below it, it's going to turn red. It's going to be resistance if and only if you see a break like this, and then a rebound of price action and a failure to break above. And once again, now this is going to be resistance if this happens. Okay. For the time being, however, we see that crude is actually rebounding from this level. Okay, and it has acted many times in the past as a support level. Okay, let's mark him there quickly. Once, twice, and you're not going to go back 4 times, 5 times, 6 times, 7, 8, 9, maybe this one 10, and now more recently you have another one, 11. Okay, super, super, super important. Okay, so from here onwards, assuming that what has happened already in the past, okay, we have a long bias. Okay, even though the crude is clearly on the losing side. Okay, can draw it like this. Okay, you see price action, you see this being as a big triangle, if you would like. Okay, or you can get it from straight from the top. Okay, and the reason why it's a valid descending trend line is because you have one touch, maybe not 3, 4 times. Okay, let me adjust it accordingly. Okay, so failure of the price action to break above this kind of level once, maybe two, three, maybe 4 times. Okay, so it this descending trend line is acting as a resistance barrier as well. The resistance bar does not have to be a linear line, by the way. Yeah, excuse me, it does not have to be horizontal. It can be diagonal as well, with an angle, with a degree. Okay, that acts as resistance as well. So at this point in time, we could have some sort of confidence that if the price action reverts back to this kind of level, we're going to get some sort of support, short order, long order. So therefore, we go long here. We sacrifice, in a sense, 6.5% in order to get 20. Okay, that depends upon your risk reward tolerance, or you may be at 10%. So 1.75 may be worth it. Or if there is enough momentum, we don't have any technical indications in our favor right now. Maybe it's going to go up to 15 because the same, because it's crude, it's kind of volatile with its movements. Okay, or we may have a target up here, which, okay, obviously you can see the risk reward ratio becoming larger and larger due to the fact that we expect more to happen. Okay, but if the price action does indeed go there, we may be feeling confident enough that something like this is going to happen. And let's not forget that we have to place resistance as well. Okay, in this kind of case, we don't have something clear. Maybe this one is. Okay, I like the fact that if you go from a longer standpoint of view, you can see it once here and 2 times there. But you get the point. That's how you use them to your advantage. Let's just do it really quickly once again. Final one, I promise. Apologies, guys. So the resistance may be this one. Okay. Let's adjust it accordingly. Yep. That's a lovely area in my eyes. Okay, nothing further in the past. Okay, because of this multiple times there, some sort of support taking place there, somewhat here, failure here, clear failure, consolidation and a break below, once again here, once again here. So this is a lovely area that I will be paying close attention to. Once again, the one we have highlighted before as support. So these are the 2 main longer term ones, if you would like. Another one in my eyes is going to be a little bit lower than that, maybe somewhere around here. We talk about longer term ones, yeah? And another one, maybe somewhere in here. Okay. So 76 and 85 are important areas for me for resistance. 64 and 52, 51 are the support levels for me. Obviously, this kind of peak is really, really nice. So we're going to use that as another resistance level for the long term. Okay. But that's how you pretty much draw support and resistance levels onto your chart. Okay. So the main direction of the market currently is obviously downwards, lower highs, okay, and lower throws. This kind of area right here, you have seen this acting as a strong support level, and we don't have a lower low, so which is important. That means bulls are watching closely this, so we have much more confidence that this may be a rebound, okay, and we're going to capitalize upon this. Whether it's going to go up to there, or up to there, depends. We'll see accordingly. But yes, that's how we approach this situation. Go long there, and you have your targets respectively. So you have 40, 36%, 23%, and 12%. Okay. 164 as risk reward, 3.3 as a risk reward, and 5 as risk reward. Okay. Obviously, for it to go up there to the 35% rebound kind of level, we need to give it a little bit more time. And we need to have enough strong bullish catalysts in order to that, some sort of supply disruption of oil, much like we see in the United States with the recent kind of catastrophe, these kind of tornadoes and all that kind of stuff, storms taking place in the Gulf of Mexico. That's why we see a rebound from here onwards. But the macroeconomic environment supports lower prices. Okay. So some other trader might have a different kind of point of view, and he may go for a short position, taking this kind of opportunity by going short and expecting that price action is not going to break above this kind of descending trend line. Okay, let me remove these kind of drawings. Nope. Actually, never mind. So maybe someone will like to go for this. Okay. Because they expect those rebounds not to take place. Okay. Let me see. July. Okay. So maybe they are expecting price action to just reverse once again and fail to break below, to break above, or it tests this kind of area right here and fails. So you use accordingly the short position. So in my point of view, it would have been much nicer to catch it on the way down after you get the confirmation that, you know what, price action is not going to break above it. So bears are in control. So you could, for it potentially go short at the $70 per area and have a target of the 51 for a 25% gain, and risking, in a sense, 10% in order to get 25 risk reward ratio, 2.5%, 2.5, super decent. If and only if we see the failure of the price action rebounding and breaking above this descending trend line and shifting the trend. Okay, for the time being, this, from my point of view, what I'm seeing right now, we're going to see some sort of consolidation in these two bounds, 75 and 64. Okay, so guys, we're running out of time. We're going to keep it here. This logging in and out of trading view has been pain in the ass. We're going to fix this next week when we're going to do our next episode of our series. For the time being, we're going to keep it here. Thanks for watching. If you do have any questions, please send them through. If not, we're going to keep it right here. Okay, so I don't see any questions. Perfect. Have a good weekend, guys. Thanks for watching. And again, we're going to catch you on to next week. Okay. Ciao. Bye-bye.